Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. This show gets you insight on everything mutual fund related. What should you buy? What should you sell? What should you hold in your portfolio? All of that and more. On today's episode, we're focusing on quite a popular equity mutual fund category, and that is the Flexi Cap category. In case you're unfamiliar with how this category works, it is what gives the fund manager a blank slate to work with, while several other schemes have restrictions in terms of market capitalization allocation towards or how they construct their portfolio. For example, like the large cap actively managed schemes have 80% minimum towards the large cap category. Multi-caps have minimum of 25% to each of large cap, mid cap and small cap, and 25% for whatever the fund manager chooses. The Flexi Cap category allows the fund manager to choose whichever stock they want in whatever allocation they see is fit. Now, we're talking about this because we want to talk about one of the outperformers over the last several years. In fact, let's pull up the top performing schemes, and the data that we have has to do with the degree of outperformance over the benchmark that they have. And you see right on the top of this list is GM Flexi Cap Fund, which has, along with Quant Flexi Cap Fund, outperformed its peers to a very large extent. Now, this show also gets you the insight from fund managers, and I like to call them onto the program to try and get you to understand how they're looking at asset allocation, how they're looking at building their portfolios, what policies they follow when they're constructing their portfolio. And to that end, my guest today is Satish Ramanathan, who's the CIO of Equity of JM Flexi Cap Fund. Thanks so much, Satish, for taking the time, and pleasure speaking with you. Could you take us through what you're seeing in the equity markets right now? Because a lot of your peers, a lot of the market watchers right now are saying that valuations are stretched and that it is difficult for a stock picker to find value. Not impossible, but difficult.
Good afternoon, Alex. Thanks for having me on the show. Yes, to an extent, the valuations have become higher than what they were last year and the year before that, for that matter. But we also have to understand that corporate India has deleveraged. Corporate India has a changed animal considerably, with net profits of 14.4 lakh crores and a higher cash flow than what this number would suggest. So the potential growth that is possible for corporate India is significantly higher than what we could see 2 years back. And we see corporate India as in the large cap companies, the mid cap companies, and small cap companies having paid down debt considerably and are looking for the next leg of growth, which would come through in the next 2 to 3 years. So we have a strong balance sheet and a visibility of growth, which lends to this optimism.
Okay. We'll delve a little deeper into the portfolio construct in just a bit, but just to set the context for that, could you take us through the philosophy that you follow when you're selecting the stocks that make up your portfolio?
Yes, thanks for asking this question because we get this asked by a lot of our investors. So what we do is we actually follow the diamond strategy, where we look at the top-down macro. We look at what is driving growth, which sectors have tailwinds for consistent growth, and we map it with the companies that are able to execute flawlessly. So they should have a strong balance sheet, committed management, and an ability to execute the strategy required in a fiscally prudent way so that we are able to get the best of both worlds. And we call this the geek strategy. The diamond shaped strategy of top down and bottom up mutates into the geek strategy, which is growth in earnings with earnings quality. And as we keep filtering the companies, we are dynamic across sectors, across cap curves, because we know that growth cannot be restricted to only one sector for a long period of time. It turns around and we see pockets of undervaluation in some other sector. So we trim the performing sectors to some extent or book profits, and move to the next sector. So it is this dynamic approach in our Flexi Cap fund, which is a true to label Flexi Cap fund, that has helped us outperform in recent times.
That's interesting because, um, I'm looking at your June end fact sheet, and that points to 40% allocation towards large cap, around 19% towards mid cap, and 39% towards small cap. And that broadly looks at the kind of allocation towards market capitalizations. Can you talk about how this has shifted, if at all, over the last 3 years or so?
Yes, in January 2020, we had a large cap allocation of 93%. And as we were doing our bottom up research, we understood that large caps were not the only companies that had turned around, but there was significant turnaround in mid caps and small caps. And that helped us take a step gingerly towards mid caps. And towards September of last year, we started cutting down mid caps and increasing small caps. So this is how our allocation has worked, because we found that mid caps were a little more expensive relative to growth as compared to small caps.
And
And
that
that's how the philosophy has evolved over time.
And that continues to be the case, Satish? Or would you see, for example, and we're in July of 2024, you've just spoken about the reasons why, your, or to a certain extent, certain reasons why the valuations to some extent are justified. The potential for growth is there in several companies. Deleveraging has taken place. Will this portfolio dynamic in terms of allocation towards market capitalizations, will that shift meaningfully, or do you think that it will more or less be the same?
So in the case of large caps, what we find is large caps would be growth will be limited. And the only way they can grow is to buy new businesses at a cheaper price than what they currently trade at. So we call it the Goliaths of India. And the way they can grow is to buy into growth. Whereas the smaller companies, which are in newer sectors, we see that as a long-term growth opportunity, and they can continue to grow in their space unhindered.
Okay. I see that, and correct me if I'm wrong, around only 2% of cash as a percentage of assets under management. Is this something that will more or less always be the case? Will you ever use cash? Will you ever hold cash, or will you always deploy?
We, in general, deploy cash across sectors, across opportunities and timelines. We do not use cash as a tool to kind of de-risk or de-lever the portfolio in any way, because cash is meant to be deployed into the best available opportunity at that point in time. And that's what our philosophy towards cash is.
I want to talk about sector allocation, and I see the top 3 holdings are all banks, large banks at that, and your allocation towards financial services is your single largest allocation at 22 odd percent. Of course, others have more because you are quite diversified, as you pointed out, across sectors. But could you explain to me why you're so bullish on financial services?
No, I think to some extent the pool of profits in financial services is the largest. While they are not growing necessarily as fast as we expected them to, the valuations have also become more reasonable. In financial services, we have distinctly divided our financial services into 2 buckets. The first bucket is consumer-facing financials, and the second bucket is infrastructure financing. And this is how we have actually demarcated the financial services basket exposure. And we believe infrastructure funding is going to be the next long-term growth opportunity. And therefore, we have a mix of both in our allocation.
Interesting. Uh, Talk to me about what you believe is going to be the major growth area in your portfolio based on the allocations that you've made, the thesis behind the current portfolio selection.
So the thesis behind the current portfolio selection is it will be growth as usual. We expect cap goods and infrastructure to do reasonably well. Valuations are stretched, so on a tactical basis, we may increase exposure to defensives from time to time. But having said that, we are optimistic that the growth in infrastructure will continue to deliver superior returns.
Satish, I'm not asking you to project what will happen. Practically nobody can do that. I haven't met someone who can do that yet. But having said that, over the last 3 years, you've been a significant outperformer. And the outperformance, the degree of outperformance, particularly over the last year, is startling to say the very least. One, would you say that some part of that is because of easy maneuverability? Do you think that getting significant inflows from this point and building your asset base very significantly will limit the nimbleness that you have so far been able to achieve? And two, do you think that caution is warranted from the perspective of the investor, at least in terms of setting expectations?
As regards point two, definitely yes, because the valuations are richer than before. So the growth momentum in stock prices need not map necessarily the kind of earnings momentum that we have seen in the past. So we will see a bit of a disconnect there coming in from time to time. One. As regards the earlier question, in terms of our size becoming a handicap, right now the size that we have is very comfortable in maneuvering the portfolio, as you rightly indicated. But we do not think that it is going to actually deter us if we become bigger in terms of moving the portfolio. I think a lot of churn is required in a dynamic market, and what our philosophy and our process throws up is what we follow rather than necessarily saying that it's a buy and hold strategy. We reassess ourselves, our portfolio, vis-a-vis the actual dynamics that are taking place in the market and the industry, and then we allocate accordingly.
Okay. Last question, Satish, and not necessarily a tough one because I think you've already had conversations about this. What, according to you, is the key risk, both for your portfolio as well as for the Indian equity markets in this year?
I think the key risk is, of course, the US elections and the outcomes of US elections and what it does to trade, etc. But that apart, I think the Indian economy has matured considerably. The sizes of the companies have grown tremendously. There is a higher degree of stability of these companies' cash flows, and the discipline that we see across managements in being capital efficient, in being focused on the financial performance, and ensuring that they do not take undue risks is what gives us confidence that there will be pullbacks, but the pullbacks will not be as severe.
Fair point. Satish, pleasure having you on the program, and thanks so much for taking the time. First half of this show, we had a conversation with the CIO equity and the fund manager of JM Flexi Cap Fund. And we spoke about the reasons why they have done well over the last several years. We're going to talk about this category in more detail, and we're in conversation in this half of the program with Santos Joseph, the founder of Germinate Investor Services. Santosh, hopefully you had a chance to listen to some part of that conversation that I had with Satish. One, what do you make of the performance, or rather outperformance, of this particular scheme? And I see this in conjunction with the outperformance that Quant has managed in this category as well.
Hi, Alex. Good afternoon. I was lucky to catch the conversation. I heard Satish and you speaking. I think clearly Satish has been able to think differently as far as the flexi cap is concerned. Now, to begin with, flexi cap is our today diversified equity category, which is basically the go-to category when someone wants to consider or begin investing in equities. But also, if you look at the origins of the flexi cap as a category towards the end of 2020, when the SEBI rationalization of the schemes happened, it was one fund that gave the fund manager the true flexibility of how you would like to manage the fund. Post that, if you notice, majority of the fund managers have got by and large a thumb rule of how much they want to be in large cap, mid cap, and small cap. They're not just veer off too much from the benchmark orientation itself. Whereas the guys who have gone slightly away to be a lot more, uh, you know, uh, flexible in terms of their approach. A classic example here is Satish at JM. He proved that by taking that bet of how you play the market caps versus how you play the sectors, plus how the market fabric had changed, is the reason why a flexi cap has got good outperformance. I think likewise with quant. Whereas the industry average is between 60 to 70% in large cap, these two guys have a slightly different breakup on the market cap side, on the sectoral side, and even on the way they picked up stocks very simply bottom up.
That's an interesting perspective. And I would think that this would be one of the factors that leads to outperformance, underperformance down the road as well. There is a certain amount of risk associated with positioning yourself to a larger extent in the broader end of the spectrum as well on the downside, right? We haven't seen a significant drawdown in the last 2-3 years. And so therefore, to that extent, we've not seen how this fund and other funds that have outperformed, how they will weather a major downturn. Is that risk something to bear in mind?
Definitely, that's one risk to bear in mind because let's be honest, the last 4 years have just been a beautiful one-way rally. Any small corrections that have come have all been bought into. Now, the other thing that one should consider is that these are a strong activity by the fund manager in terms of actually using the flexibility window. Now, let's look at all the other funds which were not able to deliver on the lines of JM or Quant. Why did they not deliver? Is because they largely stuck to the mandate of how they should manage a flexi cap fund, maybe 60-70% large cap, the discretionary exposure to mid cap and small cap. Now when you look at these funds, they have gone 25, 30, 40% into mid cap and small cap, depending on what they felt the market was going to reward them for. So there is a element of fund manager conviction, fund manager confidence, and that itself can at some point become a little bit risky if you extrapolate this for 5 year, 10 year, because what if the fund manager is not able to cite the changes that are coming in the future?
That's a fair point. The last question on this category is when somebody is investing, you said that it's a great avenue for those that are cutting their teeth in the mutual fund space, if they're choosing their first investment to make. What, according to you, are the funds to choose? Because ultimately, there are two very clear outperformers. Would you go with the winners?
Well, it's a problem of plenty. And in fact, even if you remove these top two winners, I think the rest of them also have done pretty reasonably well. And at some level, the answer for this is the amount of the unit of risk or the amount of risk one takes to be invested in a flexi cap. Now, also, I think to be fair, both GM and Quant have got the huge benefit of maybe 3 to 4 years ago when the new category was formed, they were fairly small in size. So they both had the luxury of being a small size flexi cap fund versus against the general market, which was slightly large in fund, and their consistent flows they kept receiving month on month, quarter on quarter, also gave them a lot of leeway. But otherwise, FlexiCap is a great go-to category for the people who are beginning their equity investment. And you have many such ways to choose a fund. Number one, you have the tried and tested, the HDFC FlexiCap, the Kotak FlexiCap, the ICICI FlexiCap. Now you have a lot of new players also have done phenomenal track record. For example, I think just a couple of weeks ago, 361 FlexiCap finished a a 1 year period. Similarly, I think Helios in a month or two will finish a 1 year period. Now, you also have strong performance by even new guys in the Flexi Cap scheme, where the fund size is good and the fund manager's got a great track record, and even the portfolio construct looks good. So I think you're now spoiled for choice. Depending on the size of the fund and the pedigree of the fund and the age of the fund, you can choose some of these funds.
We have time to take a few questions, and the first one that I'm choosing to take is Zaid's question, and he's asking about HDFC Defence Fund, and it's an interesting one, Santosh. This is a fund that has stopped fresh SIPs. It stopped lump sum investments within a week or two of the launch of the fund. He says that he's got 2.3 lakh invested in the HDFC Defence Fund, and in fact, he's saying that he's got an active SIP of 10,000 rupees in the fund. He's asking if it's time to shift, or is there more fuel left?
I think Zaid is one lucky investor to have parked the money when the fund was open and to make well over 100% return last 1 year. But see, what I don't know is whether this is a part of his portfolio or this is all of his portfolio. Now, notwithstanding this, I'm hoping that if you have invested at the beginning and you've made this kind of money, I think you should continue, because defense actually is maybe a lot more long-term story. Though much of the returns many people believe is front-ended, or there's so much of heat map right now on the defense story. But I think if considering Zaid's age of 28 and you have a long-term orientation towards investing, you should let it continue, both your lump sum and your SIP investments. But be careful, it should not become the only part of your portfolio.
Fair point. And thematic and sectoral, you generally talk about 10 to 15 to 20% to the extent of your equity allocation. Ravi has got a question. He's 54 years old and he's looking for a fund suggestion. He's got 10 to 15 lakh that he needs to invest. The window that he's selected, or the time frame, is 15 to 18 months. The reason for the investment is to pay for his daughter's fees, I would think for college or something like that. And he needs, therefore, a low-risk fund. But he's saying he's looking for a fund with equity taxation. Is there a hybrid fund that you would suggest, or would you suggest generally in this time frame you would look at a fixed income category?
So there is now a kind of a crossover between these. One is that you straight away look at arbitrage for a fixed income proxy, because the arbitrage fund gives you, number one, to begin with equity taxation, and some of the arbitrage funds have 30 days to just 90 days exit load. So you don't need to worry about the exit load. Now, the other part is there are also some equity savings funds which have maybe less than 15 or 20% exposure to equity. Now, if you have a little bit of risk appetite, then you can look at an equity savings as a category for this time frame. But if you really do not want to do anything to do with equity volatility or risk, then I think you're better off in an arbitrage equity fund, which should be ideal for that 15 to 18-month period. I think even after the new taxation rules that have kicked in, effective budget on 23rd July, post-tax, I think you'll do better off than a standalone deposit or a fixed income product. I think that should be more or less an ideal equity taxation and that time frame investment for Ravi.
Okay, all right. Santosh, thanks so much for an engaging conversation and for answering those two questions at the end. Pleasure having you.
Thanks, Alex.
All right, that brings us to the end of this edition of the Mutual Fund Show. Hopefully it's been beneficial for you. Do stay tuned, lots more coming up over the course of the day. And this is NDTV Profit.